What's up, everybody? So today we're going to be talking about options. I'm going to be telling you guys what they are, how to use them, and how I use them to make money. All right, so first, what is an option? So an option is a contract over 100 shares where you could either, gives you the right to either buy 100 shares, which is a call, or sell 100 shares. And so I'm going to show you. So if you wanted to do an option, let's say you wanted to do, let's say Apple. So you got an Apple, and then you trade options. But first, you got to make sure that you have trading options enabled on Robinhood. And then, all right, so here we have the expiring March 13th. This is the expiration date. So the contract expires on March 13th. And on March 13th, you can decide whether you want to exercise the option or not. But most of you won't be exercising options because that takes a lot of capital. So for instance, if you wanted to exercise, let's say you had the 290 call, and on March 13th, when it expired, well, before it expired, you decided to exercise the option. That would cost you $29,000 for you to exercise the option. But most of us don't have money like that. So what we're gonna do is, so first you look at the call. So like, all right, so for the day here, let's look at this chart first. So today it went down $9, right? And that's 3%. That's a lot for a stock like Apple to just go down. And so let's say you were bullish on this stock, right? So that means bullish means you think the stock is going to go up over time, and bearish means you think it's going to go down over time. So if you're bullish on this is an amazing opportunity to get options at a very, very low premium than it usually would be. And premium is just how much you pay for the stock. So right here you see, let's say the 295. So the 295, you would pay $828 for this contract, right? But before this morning, it was 35% higher than 828. So because of how much the stock dropped today, you'd basically get a 35% discount on this call. And when you're trading options, I always say you want to, sometimes I don't want to say sometimes you can't help yourself, but it's always best to buy calls when the stock goes down or like has like a red day, or the stock doesn't do good that day. It doesn't need to drop a whole $8, but just a day when it's not going up, the prices of the calls are going to be cheaper. And then if you want to buy puts, so you think stock's going to go down, on a day it goes up, that's when you want to buy the puts because they'll be cheaper. And that will also cut your risk because, all right, so buying calls and puts, your max risk is what you pay. So let's say I thought that Apple by the 13th of March, which isn't going to happen, is going to hit 315, right? So that will cost me $117. You have to remember that dealing with options, the prices, you always move the decimal 2 places because it's over 100 shares. So this one contract holds 100 shares, so you always have to move it. So the price would be $117 for this, right? But this morning it was more. So this morning it was 48%. Let me do a little calculation real quick. So this morning it was $173, right? So let's say you bought this for 117, and then the next day it went back up to what Apple started at this morning, which was, or it's not what it started at, it's what it closed at the previous day. So let's see what it closed at yesterday. So yesterday it closed at 296. So let's say the stock went up to 296 the next day. Most likely your option would be about, what was it? 173. So you'd make money because you bought it at a low price because the stock was going down, and then you'd make money. You'd make more than if you bought it as a stock was going up. Because let me show you one where it's going. Okay, I could just show you puts. Because the stock was going down, the puts rose in value. See, this one went up 113%. So more than doubled. So it was probably like 450 around that. And this person, if somebody decided to sell it, let me show you one that I got. So I bought this yesterday. I bought this put yesterday. So when I bought it, I lost $11 yesterday. So yesterday I bought it. The value went down $11, but then today it went up 28. So my total return is $17. So basically I made $17 in a day, which isn't bad. I could have sold it, but I'm just going to hold it because I think the market's going to go down a little more, make a little more money. All right, so overall, options is a good way to make, I don't want to say quick money, because most of the trades that I do are at the least 2 weeks away, because when I first started, they call them weeklies, where, here, let me give you an example. If you want to do a weekly on Apple, it would be March 13th. So the reason you don't want to do this is because if you, let's say I buy this, right? And I'm like, oh, I think Apple will be above 290, 250 by March 13th, right? If Apple starts going down, you know what I'm saying? You don't really have much time between now and your expiration, which would be next Friday. Like, that is not a long time for the stock to rebound, you know what I'm saying? And that's, what would that be? Whichever one. That'd be $945 down the drain if you decided to hold it even while it was going down and try to wait for it to come up. So what I do usually, when I buy calls or buy puts, like just buy them and don't do spreads, well, I usually do about 22 to 30 days. Usually just stick with 30 days. So go to, like, you do April 3rd would be a good one for this one. Those are also more expensive, so you have to take that in mind. But look, on a day where it goes down, if you believe the stock is going to go up, you could buy a cheaper one, like right here. Look, this is $82 for Apple to hit 342.50, right? That's not gonna happen, right? Let's say this one, $174 for Apple to hit 332.50, which is a strike price, and that's not gonna happen. But because of how much it went down today, if the stock goes up tomorrow a good bit, like $1 or $2, you'll probably make like $50 to $100 profit because of how much it dropped today. You see what I'm saying? So, and then also buying an expiration with a month of time, you know what I'm saying? Like, you have time for it to go through the market transition where it goes up and down. You know what I'm saying? You could still end up being wrong if we're in a bear market, which I believe we're in right now, but it gives you some wiggle room, you know what I'm saying? And then if you decide to do spreads, like I mainly do spreads recently. They're the cost is a lot cheaper, but I mainly do spreads, and you want to do those in a 30 to 45 day time frame. So I'll do any of them. Call credit spreads. Call credit spreads, that is bearish. You believe the stock's gonna go down. Call debit spread means you think it's gonna go up. Put credit spread means you think it's gonna go up, and put debit spread means you think it's gonna go down. So right here, let me see. I have a lot of them on SPY. Me personally, I feel like I bought them all like kind of around the same time frame, and I shouldn't have done that. I would have made a lot more if I would have bought yesterday. Yeah, yesterday the stocks like shot up, and if I would have bought some puts, some spreads yesterday, I probably would have been able to sell them at 50% total return, making about at least $75 in a day, not to mention if I bought multiple. So this one, let me see, this one right here. All right, so this one right here, it expires on the 17th of April. So I have until the 17th of April for Apple to be below 290. As long as Apple is below 290 on this is a put debit spread. As long as it's below 290, I will make, well, when I close this option, I will have $500. And for this one, I paid $165. So 165 minus $335, right? And that's in a month, you know what I'm saying? Like, that's a that's a nice amount of money. Not to mention if you do multiple. So if Apple's below 280 by the 17th of April, when this expires, I will make around $335. That's my max profit. When you do spreads, the profit's max. And the way I got that is the spread between these two. I bought the higher put and I sold the lower one. And this is because I think it's gonna go down. The stock's gonna go down. The spread between these is 5. So as you know, with options, $5, it would be 500. So it's 500, and then whatever I pay for, whatever the average cost is, whatever I pay for it in the debit spread, you subtract that, and that is your max gain. Okay, so your gain doesn't have to be it doesn't have to be max. Like me personally, I like to wait. Usually, if I do it right, I'll get I'll be able to cash in about a week or two and get 50%. So in about 2 weeks, I should make about $167.50 off of this spread if I do it correctly. Not to mention, now if you do that consistently, just think about how well that would go. But yeah, so yeah, that's basically what options, you know what I'm saying? If you have any questions, just let me know. I feel like there's a lot I'm missing out, you know, but I'm kind of new to this. So if you have any questions, feel free, leave them below. I'd be happy to answer them. And appreciate y'all. Make sure you hit that sub, that like, you know, share the video if you enjoyed it and if it helped you. And I will catch y'all later.